When it comes to the stock market, it's never as good or as bad as it may seem. Hello and thanks for joining us for this week's fastest 4 minutes in finance. I'm Scott Inman. Well, investor attention was locked in this week on Liberation Day. Wednesday, President Trump announced his plan for more tariffs, and tariff has become the economic buzzword of 2025. Fear over the long-term impact of new tariffs has led to a significant pullback in the market. Now, you know we shoot you straight on this segment. It's about perspective, not headlines. And here's the reality. No one knows the long-term impact of new tariffs. One of the main reasons why? No one knows what changes could be made along the way and when those changes could be made. It may very well be years before we see an actual economic impact from tariffs if they are in place for that long. So instead of worrying about the unknown, we should focus on the known. And what we do know is economic data is softening, but there is no recession in sight yet. The February Personal Consumption Expenditures Index, which is a measure of consumer spending on goods and services, grew at 0.3%. Well, what's that mean? Well, it was about what was expected, and it shows consumer spending is not sliding off a cliff, but it's also not very robust. February inflation data showed shelter prices are cooling, but the prices of some goods are rising. Real incomes are slowing as the labor market cools. So it's a pretty lukewarm economy right now. Many economists believe the data is so lukewarm it's not likely to sway the Federal Reserve either way when it comes to interest rates. So we will likely keep chugging along slowly for now. LPL Chief Economist Dr. Roach reminds us that a recession usually begins with a sudden shock to the economy, and we haven't had that yet. But he also reminds us recessions are relatively common. They happen every 5 or 6 years. The last one was 5 years ago during the COVID-19 pandemic, and technically that recession lasted only 2 months, the shortest on record. The average recession lasts 10 months. Roach writes the economy is probably not in recession at this point, but uncertainty about Fed policy, interest rates, inflation, and trade wars put a damper on how consumers and businesses feel about current conditions. So this is a great time to highlight the importance of creating a financial plan personalized to you with your goals written down on paper on purpose, because a plan doesn't feel. So when you're tempted to respond to a market downturn or bad economic news, you're less likely to flinch. Your plan should expect bear markets and recessions over the long haul, and your investment strategy should be aligned with your time horizon to retirement. If it's not, it's time to change your plan. Thanks for watching.
Want to become smarter financially in 4 minutes or less? Sign up at fastest4.com to get insights and updates like this delivered to your inbox weekly.